September 15th, 2008. Wall Street opened for business. But something fundamental never opened with it. Trust. That morning, Lehman Brothers filed for bankruptcy. A 158-year-old investment bank had collapsed. At first glance, it looked like another corporate failure. Another company making bad decisions. Another bank running out of money. But that wasn't what terrified the financial world. Banks fail. Businesses fail. That isn't unusual. What happened next was, within hours, banks stopped lending to each other. Credit markets froze. Investors panicked. Companies couldn't borrow money. Families couldn't refinance their homes. The gears of the global economy began grinding to a halt. Lehman Brothers didn't destroy the financial system. It exposed something far more dangerous. Nobody knew who they could still trust. To understand Lehman Brothers, you first have to understand confidence. For more than a century and a half, Lehman had survived wars, depressions, market crashes, recessions. It had become one of Wall Street's most respected institutions. If Lehman was involved, people assumed the investment had already been carefully analyzed. At the same time, America fell in love with housing. Buying a home wasn't just a financial decision. It became a symbol of success. Banks made mortgages easier to obtain. Interest rates remained low. House prices kept climbing. Everyone believed one simple idea: housing prices don't fall. And once a belief becomes accepted as fact, entire financial systems begin building on top of it. The housing market looked unstoppable. As more people bought homes, prices continued rising. Banks realized something. They no longer needed to keep mortgages on their own balance sheets. Instead, they bundled thousands of mortgages together. Those bundles became financial products. They were sold to investors around the world. Suddenly, a mortgage in Florida could end up inside the portfolio of a pension fund in Germany, or an insurance company in Japan. The risk appeared to disappear, but it never actually left. It was simply spread across the financial system. The more complex those products became, the harder they became to understand. Complexity created confidence, even among people who didn't fully understand what they were buying. Now, let's follow the money. A family buys a home. A bank issues the mortgage. Years earlier, that would have been the end of the story. But by 2008, it was only the beginning. The mortgage was sold, combined with thousands of others, packaged into mortgage-backed securities, then repackaged again into even more complex financial products. Those securities were purchased by banks, insurance companies, investment funds, governments. The same dollar passed through countless institutions. And every time it changed hands, the connection between the original homeowner and the final investor became harder to see. Eventually, nobody knew exactly who owned what, or who was carrying the real risk. The money kept moving. Transparency didn't. Then homeowners began missing mortgage payments. Housing prices stopped rising. Some began falling. Those complex securities suddenly became impossible to value. Nobody knew how much they were actually worth. Banks looked at each other and hesitated. If Lehman could fail, who would be next? Trust disappeared almost overnight. Lehman filed for bankruptcy. Stock markets collapsed. Governments rushed to rescue other institutions. Not because every bank was insolvent, but because nobody could prove they weren't. People often ask, didn't anyone see this coming? Many did. Economists warned about the housing bubble. Some investors questioned the growing complexity. A few hedge funds even bet against the mortgage market years before the collapse. The warning signs existed, but they were drowned out by something much louder: success. For years, everyone involved had made money. Homeowners, banks, investors, rating agencies, politicians. When every participant benefits from the system, very few people feel motivated to challenge it. The uncomfortable truth: financial bubbles rarely survive because nobody sees them. They survive because almost nobody wants them to end. Most people think Lehman Brothers collapsed because it ran out of money. That isn't entirely true. Lehman collapsed because confidence ran out first. Money can move quickly. Trust moves much more slowly. And once trust disappears, even healthy institutions begin to look dangerous. Financial systems don't collapse because money disappears. They collapse because trust does. Lehman Brothers wasn't another Ponzi scheme. It wasn't another accounting fraud. It wasn't another startup deception. Yet it followed a familiar pattern, a compelling belief, growing confidence, increasing complexity, Warning signs ignored. Transparency disappears. Trust collapses. Reality arrives. Every financial crisis has its own story, but almost everyone begins the same way. People stop asking difficult questions because they believe someone else already has. Every financial collapse leaves behind two stories. The story history remembers, and the story the money tells. At Follow the Money Crimes, we investigate the second one. Because people can lie, markets can panic, institutions can fail, but money always leaves footprints. And sometimes, the most important thing it reveals is where trust disappeared. See you in the next investigation.